So Sophie touched on where you sell the carbon credits is very important, who the buyer is, how do you sell them? And this is where carbon markets come into play. And so the majority of certificates in things like cap and trade schemes are not sold peer-to-peer. So in the example I gave earlier about the two cement factories, one coming in under the allowance and one coming in over, it's actually very unlikely that cement factory 1 would sell to cement factory 2. Typically, sellers of carbon credits will sell them to trading houses like Trafigura, who also trade commodities like oil and power, and buyers will go to the trading houses. There are also specialist brokers available. And one of the reasons for this is that because it's a traded market, prices are volatile. You can see in the graph on the right-hand side, the volatility of both the UK carbon allowances and EU carbon allowances over the past couple of years. And so by working with a trading house or a broker, a lot of the time companies will buy carbon credits on long-term offtake agreements or long-term sales agreements to get that price certainty. Within a market, allowances are interchangeable, but under most of the cap and trade schemes, you can't sell between markets. But as Sophie mentioned, with some of the emerging compliance markets in fuel obligations, there will be opportunities to sell, particularly between the UK and the EU. A lot of work's ongoing at the moment to make sure that the two systems line up. And so again, this is where trading houses are able to bring their knowledge and expertise to the fore in order to make those purchases and sales as profitable as possible for themselves and for their customers. In order to make a compliance claim, a certificate must be retired or surrendered, which means it's taken off the market. And so with things like EU ETS, a set number of allowances are given at the start of a 5-year period. And you see a lot of trading activity throughout that 5-year period, but particularly towards the end because of each year. Because if you are an entity that needs to comply and you haven't surrendered the sufficient number of certificates by the end of the year, you face financial penalties, and sometimes you're at risk of losing your license to operate. And so that drives seasonal volatility. And over time, the number of credits available fall. So each 5-year period, the EU and the UK government reduce the number of carbon credits available on the market. And that's a very clear policy decision to create financial imperatives for businesses to invest in R&D, to invest in new technology, to invest in energy efficiency measures and renewable energy to bring carbon emissions down, which is why carbon credits are such a powerful policy tool, because it's creating that very clear financial incentive. And because this is quite a mature market, there's very clear secondary markets, which is where these trading houses and brokers come in. So as I was saying before, it's very unlikely that somebody in the market for carbon credits in the EU or the UK will go to another entity within that market. They'll almost always go through a trading house. So that's that secondary market. And the other cap and trade schemes are pretty similar as well, but less mature than the EU and the UK cap and trade schemes. And one other point to note is that these schemes are expanding. And so when they first started, it was only a handful of big, high revenue, high polluting businesses that were included. But over time, the legislation has been including more and more businesses. And the driver behind that really is that there's a policy decision that smaller businesses shouldn't be the ones that are paying for the technology development up front, but that now that these systems, these cap and trade systems have been in place for a while, investment has gone into technologies that make them affordable for smaller businesses, and therefore these smaller businesses are being incorporated in an attempt to drive down total carbon emissions. The voluntary markets are very, very different. They are much more global. There's not really any restriction on where a certificate is generated from as to where it will be retired for an entity to claim an emissions reduction. In fact, in some ways, for a lot of corporates that are looking to make net zero claims, it's better that the certificate is generated much further away, geographically speaking, because that makes it easier to claim that it was a carbon reduction from outside of its supply chain, which is part of the definition of corporate net zero, is that any offsets are done outside of your supply chain. You can buy directly from projects, or you can buy from the verifiers. So particularly sort of small, medium-sized businesses that are looking to buy a couple of 100 tons, working with a trading house, it's not financially viable at that scale. And so if you go on the website of someone like Gold Standard or Vera, the two certifying agencies, you can actually just buy bundles of credits from different projects that they've certified. There are also specialist online platforms and specialist brokers out there. A lot of the time, information about where the certificates come from, what kind of project, vintage means what year it was produced, will impact the price of the certificate. And so, as we saw in the example about what Shell and Microsoft are spending, you can spend as little as a couple of dollars per ton of CO2 up to close to $200 a ton. And again, this is a really important part of any organization's strategy for making net zero claims that involve carbon credits, is thinking about where those credits come from and how high the risk of bad publicity is. So as you'll see on the slide to the right, this is an article from The Guardian for a couple of years back. Delta Airlines was sued for $1 billion because they were making carbon neutrality claims that were based on the purchase of credits that under investigation turned out to be junk. So in that 1 billion voluntary carbon credits market, independent investigation by, I think it was The Guardian, Dispute, and another organization found that as much as 30 to 40% of those credits were junk, meaning that there was no clear carbon reduction associated with that credit. And sometimes this is due to natural disasters. And so if you've claimed that you've generated a carbon credit because you've caused carbon to be sequestered for a substantial period of time by protecting an area of forest that then subsequently is burnt down during a wildfire, that carbon credit ceases to exist. But if you've already sold it to somebody who's retired it to make a carbon claim, that can cause a lot of issues. And so this is something that buyers need to be very aware of, is where is that carbon credit coming from?